I remember it like it was yesterday. It was late, and I was glued to a crypto chart that looked like a wild roller coaster. I was new, tossing money into Bitcoin and Ethereum because everyone else was. FOMO was real. I bought and sold on gut feelings and random tweets. No plan, just chaos, and my portfolio showed it. Then I stumbled on a YouTube video about chart patterns. The guy pointed out a head and shoulders pattern, peaks and valleys that could predict price moves. Suddenly, the squiggles on my screen started making sense. I was hooked. That night, I scoured my charts for patterns and found a lopsided triangle on an altcoin. My heart pounded. Was this the secret sauce? I felt like I discovered a cheat code. Of course, my first pattern didn't play out perfectly. Welcome to crypto. But that moment changed everything. I realized the market isn't just random, it's driven by people and their habits. Patterns are footprints of those habits left on the charts. If you learn to read them, you might get a hint of where the herd is heading. That was my first real aha moment. I wasn't just gambling anymore, I was analyzing. I was starting to think like a trader, and that changed my entire approach. So, what are crypto trading patterns? Think of a trading chart as a story, a battle between buyers, bulls, and sellers, bears. Every up and down is a moment in that fight. Patterns are recurring shapes that reveal who's winning. Imagine watching a crowd. If everyone runs one way, you know something's up. Patterns are like that visual records of market psychology. Over decades, traders notice certain shapes often lead to similar outcomes. For example, a pattern might show buyers are tired and sellers are taking over, or vice versa. It's like a house auction: fast bids, then hesitation, then a big move. Patterns aren't magic or crystal balls, they're tools for managing probability. They show moments of tension where the market could tip. Spotting them isn't about predicting the future, but making an educated guess. You're stacking the odds in your favor, not guaranteeing a win. That's the real power of patterns. Let's get into the most common patterns you'll see. First, the head and shoulders, a bearish pattern signaling a trend reversal. It's a central peak, the head, with two smaller peaks, shoulders, on either side. When the price breaks below the neckline, traders often sell. Next, the double bottom, a bullish pattern that looks like a W. After a downtrend, the price hits a low, bounces, drops again, then surges up. That second bounce means sellers are exhausted. Buyers take control. Traders buy when the price breaks above the middle of the W. Then triangles, continuation patterns that can break either way. Ascending triangles are bullish, descending are bearish, and symmetrical triangles signal indecision before a breakout. Traders watch for price to break out of the triangle's boundaries. But they don't jump in blindly, they wait for confirmation, like a spike in trading volume. Volume is key. A breakout with high volume means conviction. That's how pros separate real moves from fakeouts. Patterns can feel like a superpower, but they come with a warning. Take Sarah. She studied charts, spotted a double bottom on Cardano, waited for confirmation, and made a life-changing profit. She followed the rules and managed her risk. Then there's Tom. He saw a head and shoulders on Bitcoin, went all in on a short, ignored weak volume, and got wiped out. He lost everything because he saw what he wanted, not what was really there. For every trader who rides a pattern to big gains, another gets trapped by a fakeout. The difference? Context and discipline. Sarah was patient and waited for confirmation. Tom was greedy and ignored the warning signs. Patterns aren't foolproof, they're subjective and can be manipulated by big players. Sometimes whales create fake breakdowns to scoop up cheap coins. Relying on one pattern alone is risky. The real skill is combining patterns with context, confirmation, and risk management. That's what separates winners from losers. Don't be a Tom. So, do patterns actually work, or is it just financial astrology? Traders swear by them, saying patterns reflect human psychology, fear, and greed. Academics argue that all info is already in the price, so patterns are just luck. Some studies show patterns like head and shoulders can be profitable, but only until everyone knows about them. Once a pattern is common knowledge, its edge fades. Other research says after fees, most patterns don't produce consistent profits. Confirmation bias is real. You remember the wins, forget the losses. The truth, the jury's still out. Patterns aren't a guaranteed path to riches. Use them wisely, not blindly. So, should you ignore patterns? No, but use them smartly. Patterns are just one tool in your trading toolbox. They help generate ideas and spot entry or exit points, but shouldn't be your only reason to trade. First, always zoom out. Check the bigger trend before acting on a small pattern. Trading with the trend is safer than betting against it. Second, combine patterns with other indicators, like RSI and moving averages, and especially trading volume. The more signals that align, the better your odds. Third, practice ruthless risk management. Never risk more than you can afford to lose. Always use a stop loss to protect yourself. Patterns will fail, and you will be wrong sometimes. A stop loss keeps losses small so you can trade another day. Don't gamble, trade with a plan. Patterns are powerful, but only when used with discipline. Stack the odds in your favor. That's how you survive and thrive in crypto.